Good afternoon, everyone. I'm Sophie Weyten, Counsel in the Knowledge Management Tax team. Today we have discussions and the last webinar, which is dedicated on VAT. More specifically, VAT trends, what should be kept in mind for 2023. And for these discussions, we have a great panel of VAT specialists. First, we have Bruno Gasparotto, who is a principal in the tax law practice of Arendt. He has more than 20 years of experience as VAT expert. He advises banks, super fees, investment funds, real estate companies on VAT issues. And then we have Sophie Weyten, who is a counsel in the tax law practice of Arendt. She has an extensive experience in VAT and she advises on VAT aspects of financial, commercial transactions, as well as investment fund related matters. And finally, we have Claire Schmitt, who is also a counsel in the tax law practice of Arendt. She has more than 10 years of experience in VAT, and she also advises on VAT aspects of financial, commercial transactions, and investment fund-related matters. But before we get started, I would like to share with you again the usual housekeeping rules. So if you have any questions, please use the Q&A section in the WebEx, and the speakers will address your questions after the presentation. And if you have technical issues, please use the chat box. So Bruno, Sophie, Claire, I'm very happy that you will share with us your views on what are the trends, the VAT trends for 23, which may impact our clients.
Thank you, Sophie. So welcome to all of you for this last tax webinar of Arendt, which is so dedicated to value-added tax. As a first topic of what to keep in mind from 2023 from a VAT standpoint, I have to mention the never-ending story about the director fees. On 29 of April last year, the Luxembourg District Court made a referral to the ECJ for a preliminary ruling in the case of the VAT treatment of activities carried out by a natural person as a member of the board of directors of a public limited liability company. Following that referral, the ECJ will have to determine whether director fees are subject to VAT or fall outside the scope of VAT. In case the ECJ were to conclude that director fees do not fall within the scope of VAT, the current Luxembourg VAT treatment would be fundamentally altered. Indeed, the Luxembourg VAT authorities consider, in line with its circular dated 2016, that the activity of a director is an economic activity subject to VAT on the basis that the director provides services for consideration on a permanent basis and independently. So these three characteristics are important: for consideration, on a permanent basis, and independently. When assessing the existence of the independence criterion in the activity performed by a director, the Lux VAT authorities consider that the subordination link between the director and the companies for which he is part of the board of directors does not exist, and thus that the conditions of independence is met. What are the elements supporting that position? Firstly, directors are free to determine their working conditions by an autonomous organization of their time. Secondly, the remuneration of a director depends, at least partially, on the success of the business, while an employee would not bear the similar risk. And thirdly, directors can be civilly liable towards both the company and third parties for their actions, while employees would not. And this is specifically the case for VAT liabilities, by the way. The court will therefore have to assess whether, in first instance, an individual acting as a director for a limited liability company carried out an economic activity for that purposes, and in case this first question is answered positively, whether such activity is carried out independently. And this is, of course, the core question of this problematic that we have for years and years now here in Luxembourg, not only in Luxembourg, but also all over the EU, in the different member states, since this position about the VAT regime of directors is not harmonized. So once we would have an answer from the ECJ, probably by the end of this year, let's hope so, this will then offer a framework that will give more certainty about that sensitive topic, especially from a Luxembourg perspective. So more news to come, probably by the end of the year. Next topic then is about the temporary decrease of Luxembourg VAT rate, and I leave the floor to Sophie.
Thank you, Bruno. Hello, everybody. I'm very happy to talk a few minutes about two specific topics you may already be familiar with, but which are nevertheless important to keep in mind when dealing with invoicing obligations and applicable VAT rates, as well as with respect to the taxation of employees' cars. Let's start with the first topic, which relates to the temporary decrease of the Luxembourg VAT rate. Indeed, end of last year, an anti-inflation package of measures has been adopted by the tripartite, aiming at help households and businesses. Among the measures which have been introduced, it has been decided to temporarily lower the following VAT rates by 1%. So the standard VAT rate of 17% is lowered to 16%. This rate usually applies to services and goods which are not subject to specific reduced rates. The intermediate VAT rate of 14% is lowered to 13%. This rate applies, among others, to custody and administration of securities, administration of loans, and other services. The reduced VAT rate of 8% is lowered to 7%, and this rate applies to different supplies of goods, such as gas, heating system, repair of bicycles, etc. Finally, it has to be noted that the super reduced VAT rate of 3% remains unchanged. This rate applies to food, hotel, restaurant, water supply, books, etc. In addition to these VAT decrease measures, another measure has been adopted by the government. It provides for a permanent reduction in VAT rates on certain categories of goods and services as from 2023. So, the reduced rate of 8%, which is decreased to 70% until end of this year, will now apply to the repair of household appliances, as well as to the sale, rental, and repair of bicycles, including electric bikes. And the super reduced VAT rate of 3% now applies to the supply and installation of solar panels. But what are the practical consequences of such changes? Taxpayers must now deal with permanent rates and temporary rates when preparing their VAT returns. They have also to update their internal accounting systems and invoices templates. The contracts and agreements in force also need to be revisited, and particular attention should be paid by taxpayers carrying out a taxable cost recharge activity. Finally, of course, taxpayer will have to restore the past rates as from January 2024. But how to determine the applicable rate? And that's a very complex question. So there is a circular which has been published on 6 December 22, circular 782, which specifies the modalities of application of these new rates, considering the principle of chargeability of VAT in Luxembourg. And the chargeable even determines, in fact, the moment at which the VAT becomes due by the supplier to the Treasury and therefore also the moment at which the VAT charge is deductible at the level of the customer. Usually, such chargeable event occurs when the supply of goods or services has been completed. But how to determine the VAT chargeability? As a general rule, the chargeability of VAT arises at the same moment the chargeable event occurs. But this is not always the case, and that's of course the difficulty of the exercise. Indeed, by way of derogation, in case a VAT invoice is required to be issued, and this will happen when we have effectively a transaction between VAT taxpayers, the chargeability of VAT will arise at the moment at which such invoice is issued or should have been issued. So, in other words, by the 15 days of the month following the supply, unless in case of advance payment, whereby the invoice should be issued no later than when the payment occurs. Furthermore, derogatory rules may also apply in case of continuous supplies of goods. There are also several rules which apply to cross-border supplies, to credit notes, and for that one, just to precise that they always have to follow the regime which has been initially applied on the initial invoice which has been raised. And due to the lack of time, I cannot provide you with an exhaustive overview of different rules which apply. But as you may have noticed, the practical implementation of this new VAT rates is rather complex, and a case-by-case assessment of the different transactions is necessary. So that was for the first topic, and now we move to the next topic, which relates to the impacts of the court decision in the QM case, which was dealing with a car made available to employees, and for which the decision has been ruled by the Court of Justice on 20 January 2021, and whereby effectively the employer will be considered as liable to charge VAT on the provision of the car in the country of residence of the employee under some specific conditions which are just reflected on the slide. And the question now which arises is whether this case law has been implemented in Luxembourg and in the neighboring countries. And we are going just to start with Luxembourg. So, just as a recap, the VAT regime applicable to this transaction until this ECJ decision has been taken was the following. So the private use of the car is computed by the employer and subject to VAT in Luxembourg. And no VAT is applied on the employee's payment, if any. What happened further to the case law? In fact, the Luxembourg authorities decide to issue a circular 807, which merely summarizes the content of the court case, but does not provide for any additional guidance. It merely informs the Luxembourg employers that they may have VAT obligations in the countries where their employees reside that could lead to paying VAT abroad. The potential impact, if any, to cars provided to Luxembourg residents is not treated either. So there is no further guidance on the date of effectiveness of the computation of the taxable basis. And so, yes, we have just this circular. We know that discussions have taken place with the Ministry of Finance, but there is no official communication as regards the outcome of such discussions. But in any case, taxpayers should in any case be prepared to such taxation and of course review carefully their employees' car policies in order to be prepared for VAT collection obligations which could arise in the future. So that was for Luxembourg. What about Germany? In Germany, the practice was always to consider that effectively VAT is in principle applicable on leasing of company cars to employees residing in Germany when provided in return for compensation. So there was a circular which has been released in addition to this in February 2022 in relation with the taxation of private use of cars. It indicates that the consequences of the court case are still under discussions and that there will be an additional circular to be issued at short delay. But as per information at our disposal, this circular has not yet been published. Then, next country, Belgium. In Belgium, there was an old circular dated in 2015, which provided that the supplier of a car to a manager, director, and employee against payment is liable to VAT. And the taxable basis cannot be less than the open market value. In addition, the deduction of the input VAT incurred by the employer on the rents cannot exceed 50%. This being said, there is no additional communication which has been published by the Belgian authorities further to the decision taken in the QM case about company cars of employees of Luxembourg companies residing in Belgium. But there are some rumors about the preparation of a new circular dealing with such case and which would provide for a taxation of the provision of the car under the conditions laid down by the court. And that this taxation could eventually be retroactively applied. But so far, we haven't seen any official communication in this respect, so we have to wait for effectively this potential new circular. Last country, France. In France, there is a quite restrictive regime for company cars. So there is no deduction right granted for the company on passenger cars. There is the deduction right is only available for utility cars. And there is no specific provision dealing with the VAT regime applicable to the supplier car of an employee in exchange for payment. So also for France, we are not aware about the existence of any position which should have been taken by the authorities further to the QM case. And also there are some rumors that they are thinking about effectively they are thinking about the taxation of such supplies, but this will need to be followed. And now it's closed for me, but I leave the floor to Bruno for another interesting topic.
Very briefly, it's another topic which has nothing to do with B2C or B2B regime, but it's a new one which is called B2G, which concerns business to government transaction. And here I'm just talking about the need for having an electronic invoices in place when you supply services to the public sector and to public sector bodies. This will be mandatory as from March 2023. The aim is to facilitate the verification, the validation, and the payment of invoices addressed to public bodies. There are some exceptions to that obligation. They are mentioned here on the slide, but I would like to finish, just to briefly mention this topic by indicating that there is an alternative for this electronic invoicing on a mandatory basis. It's the fact that that the operators can use the myguichet.lu, and by using this platform, you will find an online invoicing form that needs to be filled in and sent to the public body concerned. To use this MyGuichet platform, the operator must have a business e-space on MyGuichet, and or either a LuxTrust product, like a token, for example. And by doing so, they will comply with this new obligation. But just to have in mind that this new rule for the B2G transaction will require an electronic invoicing to be put in place in a way or in another. So that was a news for this year 2023, and then we will continue with other topic which is also quite interesting to mention, which is the PSP.
So now I will briefly talk about the new VAT obligation for payment service provider, also known as a PSP. So this VAT obligation will be applicable as from 1st January 2024, and they involve for PSP to collect certain data on cross-border payment and to provide them to the VAT authority. So the aim of this new VAT reporting obligation is really to have another tool for the VAT authorities in order for them to control the transaction, and especially e-commerce transaction, through the information provided by third parties like PSP. So here are essentially concerned payments relating to a transaction with an EU payer. So not all the payments will be subject to a reporting obligation. You will have certain conditions, such as it should be cross-border payments only, and this reporting obligation only arises when you have more than 25 cross-border payments to the same payee during a calendar quarter. As regards the information to be collected, it will essentially concern information that enable to identify the payee. So such information will have to be archived for 3 years. So once the information is collected by the PSP, it will have to transmit it to the local VAT authorities, and the local VAT authorities will exchange this data with the local VAT authorities of other member states through a specific system called Central Electronic System of Payment Information, also known as CSOP. Therefore, these new obligations will really help to increase the visibility of the VAT authorities on the e-commerce transactions in particular, and it is in line with the trend that we see to modernize the VAT system. In practice, it will mean also for PSP that they will need to adapt their systems in order to be able to collect the relevant information by 1st January 2024. So another topic, which is still in line with this trend to adapt the VAT system to the digital environment, the EU Commission has published a set of proposals on 8 December 2022. So the aim of this proposal is really to modernize the VAT reporting obligation to address the challenges of the platform economy and to simplify the VAT compliance obligations. So this proposal includes therefore 3 main changes. So the first one concerns a new digital reporting obligation for B2B cross-border sales. So this will consist of a transaction-by-transaction reporting system for cross-border sales between taxable persons. So this will enable a tracking of the transactions in almost real time. This change involves notably a mandatory e-invoicing for these transactions and also the removal of the European sales listings reporting. The second change will concern an update of the VAT rules for passenger transport and short-term accommodation platforms. This typically concerns platforms like Airbnb, where you have individuals that can rent their flight for a short term. In this context, the operators that facilitate such supplies will be responsible for collecting and remitting VAT to the VAT authorities on such supplies when no VAT has been charged by the supplier. So this is the case, for instance, when you have a supplier that is a small business or an individual. The third change will consist of an extension of the single VAT registration across the EU for businesses selling to consumers, so for B2C transactions. This proposal would allow business selling to consumers established in other member states to register for VAT only once and to fulfill their VAT obligations through a single online platform, which is called the One-Stop Shop System, the OSS, or the Import One-Stop Shop System, the IOS. In addition to this online platform for import of goods will be mandatory for platforms facilitating the sale of goods from third countries in certain cases, whereas at the moment it is only optional. So at this stage, these are only proposals that need to be adopted by the EU Council and the EU Parliament. However, this is something to keep in mind and to follow, as it might have important practical implications. So that was it from my part.
Thank you very much for all those very clear presentations. So maybe we can take a few questions. So, yes? That's fine?
Let's do it.
Yeah, okay, so we have a few questions on directors' fees actually. So what could be, in your opinion, the decision of the ECJ on the VAT treatment of directors' fees? If the court considers that directors' fees are not subject to VAT, what will be the situation for the past?
Well, it's always complicated to anticipate what could be the decision of the ECJ on a specific topic. We do not have, of course, any crystal ball to see that for the future. But this being said, of course, there are different opinions on this complex topic. But what makes quite, let's say, clear, or at least close to be obvious, is that effectively it seems to me complicated to say that directors does not act independently. For me, it's quite evident that the independence conditions is present here, and since that's the key point, one of the key point and most important thing to analyze to determine whether or not the director fees are subject to VAT or not, I have the impression that the likelihood to have confirmation of the taxation rather than the confirmation of the non-taxation is rather present. So I would be more, let's say, pessimistic, and I have the impression that effectively taxation would be the most probable decision of the court in this respect. And if that's the case, the impact for the past would be that there would be no change, because that's perfectly in line with the position of the Luxembourg authorities in that respect. The only point that would change is that if we would have directors appointed in Luxembourg entities for their board, and having these directors residing in foreign countries, France, Belgium, Germany, for example, this would probably imply implication for the directors himself in their home countries, which is not specifically and necessarily the case today. So through a decision of the court, if in favor of the taxation, this would give a kind of harmonized framework for all the directors in Europe, with implication not only in Luxembourg but also in their home countries.
Yeah, thank you, Bruno. Maybe so another one. Do you know if there are many VAT taxation notices issued against directors?
Again for directors. Okay.
Yes.
I'm not surprised that it's a hot topic. Well, I do not, of course, I do not have any statistic about that. I even do not know if the VAT authorities themselves have statistics in that respect. My feeling, and this is just a feeling, I have the impression that the different VAT officers are not so aggressive to chase the different directors and the different entities having their directors' mandates, just to make sure that effectively all the VAT taxation and the circular and the conditions behind that are met in practice. So I have the impression that it is not the case yet. I believe that the VAT authorities have many other files to handle of a higher importance in terms of materiality and in terms of amounts. But voilà, I do not have any statistics in that respect, so I cannot say more about that.
Thank you, Bruno. So maybe we can close the session. Thank you very much for this very interesting session, and also for your attention for the whole tax week. I think we had very insightful discussions on the trends for 2023. Yeah, and if you wish to listen again, we will make available recordings on our website. And also, if you wish to receive our slides, please make us a request and we will send them to you. Yeah, so, and also if you want to go deeper in some technical issues, then just to let you know that we organize trainings via Arendt Institute, so you have the information here, and we also organize customized sessions. So thank you very much for your attention, and I wish you a very good day.
Thank you.
Thank you.
Bye-bye.